Alright then, good morning everyone as we head into European trade on Wednesday the 8th of May. We'll flick across markets, see what's going on, and a relatively quiet start to the week. I mean, stock upside on Monday, so a bit of positivity kind of filtering through up until today with certainly with the equity markets. A little bit of a chop sideways yesterday, but obviously it cannot continue to go higher forever, but we'll talk about that in a minute. Asia stocks slip, dollar climbs as Fed rate path pondered. I mean, they're just thinking about what the Fed are going to do in the future. That's what the article says. If the main article in the global markets thing is saying that markets are deciding what the Fed might do, it kind of says that there's not much in the way of fresh news flow for us to go off. Bank of Japan issues stronger warning over the Japanese yen's impact on policy. Like, I mean, they can intervene all they want, but ultimately, the reason why the Japanese yen has been so weak over the last number of months and year or two is simply due to the fact that they are completely different to the rest of the world on monetary policy. Their interest rates are have been at negative, now are at zero. You know, doing near on unlimited QE the whole time. Also, their economy isn't performing as well as other economies. Yields are lower in Japan than yields are lower in Japan than they are the rest of the world, and all these factors are contributing factors to downside in the Japanese yen. So what you do then off the back of that is you sell the Japanese yen. You know, the Bank of Japan can come in all they want and start adjusting monetary policy, or can intervene all they want into the currency, but ultimately, just because they sold a bunch of dollars and bought a bunch of Japanese yen, doesn't really change the fundamentals of their currency, fundamental issue with their currency. So, warning that there is potential. I keep saying Bank of Japan, it's the Ministry of Finance in Japan, but they keep saying that, now they're saying that they may need another interest rate hike, and that's really the only way they can truly fix this issue is if they hike interest rates aggressively, like the rest of the world did. Ultimately, with the debt to GDP levels in Japan, the way they've run their economy for the last 10 or 15 years, they're not really in a position where they can go and do that. So difficult times for the Bank of Japan, difficult times for the Japanese government, and also difficult times for the country trying to battle this. So, but it's self-inflicted, to be perfectly honest. So I don't have that much sympathy for them. But that is, they hoped that Shinzo Abe, Abenomics, they hoped that would work, and it. Well, it's kind of pretty clear that it hasn't really worked, does it? And now they're in a situation where it's very difficult to fix the problems that was created off the back of that. Apart from that, it's kind of where we're at in markets at the moment. Not too much to go off. Dollars are higher across the board, which is an interesting one. I've listened to people over the last week tell me that the dollar's super overbought. We had weak labour market figures last week, but ultimately, inflation is still too high in the US. These manufacturing figures, manufacturing PMI out yesterday, last week, which was quite negative, it was negative, but then you got manufacturing prices super positive. You then had the services PMI on Friday. Services PMI was negative, but the services prices massively positive, right? And then had weak NFPs. So on face value, all the high impact data releases were all negative, but you had a couple of little low impact ones over the last couple of weeks. Those employment cost figures that we had early last week, the manufacturing prices that we had last week, the services prices that we had last week. Most people will sit there and just look at the high impact releases, but the focus is on inflation. The Fed told us on Wednesday of last week that they weren't too concerned about the labour market. A little bit of weakness in the US labour market is fine. They don't really care about that. Though obviously, if there's massive weakness in the labour market, they will care about that. But there's only a small bit of weakness like what we got yesterday. They don't really care about that, and you focus on inflation, and the inflation figures, albeit low impact, some medium impact, were still too high. And then you had the PCE figures from the week before, quarterly figures still far too high. All these inflationary numbers that are coming in still far too high. So economic data, if that continues to turn sour and turns even more sour, plus inflation still continues to rise, they are in a bad position then. But we'll cross that bridge when it comes to it. I suppose the rest of the markets across the board relatively sideways. Difficult to predict much direction off the back of that. onto the economic calendar. Look at today, not much to go off today. What do you really do with that one? We got the Bank of England tomorrow, which will be a bit more action tomorrow. But we got oil inventories. Last week, a big build in oil inventories. They've continued to sell off post that figure. They've had a solid bit of downside over the course of the last week or two. You can see this 4-hour chart continues to push lower every day. Every rally just continues to get sold back into. So interesting one the trend continues on oil, kind of ceasefire talks. They continue to talk about ceasefire talks in the Middle East, not that you're actually getting a ceasefire, but that continues to trend its way lower. But you look at equity markets across the board over the last week, super positive post-Fed and then post-NFP, then come into yesterday, and we just kind of chopped you sideways yesterday in a pretty tight range across all of these, which is to be expected. The bias is still going to be long these, you'd have to imagine, even though inflation is still kept too high and continues to be a problem. Is it the resilience that these equity markets have shown over the last number of weeks, a number of months, and even a couple of years, when interest rates were being whacked higher at the pace that they were, they had a bit of downside, but it was kind of gradual downside. It wasn't anything major. Maybe and then ended up like 20% lower, to be fair, but not exactly at a super aggressive pace like you would expect with interest rates being risen at that aggressive pace. And they are extremely resilient, these equity markets. You'd have to keep trying to buy them. On the best, it doesn't matter really what's going on in the world. You got to try and buy equity markets, but lots of money added to equity markets over the past 3 weeks. I was saying, I think it was $2 trillion since the 19th of April was pumped into the S&P 500. I don't know whether I'm reading that wrong or remembering that wrong, but that's what I thought I read yesterday. Maybe I should fact check that and go back to that tomorrow. But it's relevant, the actual figures. They're super resilient. They didn't have positive earnings over the last couple of weeks across the majority of the bigger companies, so that continues to be supportive for stocks. Certainly, they look like they want to have a bit of a pullback just visually looking at the US indexes, but I'm not going to want to trade those pullbacks. Any pullback should be a dip to buy back into. You would think US dollars though pushing higher over the course of this week, which the bias, certainly from a fundamental perspective, interest rates in the US are going to remain higher than the majority of these other countries, are higher for longer than the majority of these other countries. The ECB are going to cut interest rates before the Bank of England are going to cut interest rates before the Bank of Canada are going to cut interest rates before. The Bank of Japan's interest rates are at 0%. The Swiss National Bank have cut interest rates before. The Aussie and the Kiwi are slightly different. They're probably in a similar boat to the US, but ultimately the rest of them are going to cut interest rates sooner, so you just avoid the Aussie and the Kiwi. So the bias for me from a fundamental point of view is still pointed higher in the US dollar. It is probably overbought in the near term. You will need some sort of a pullback, but ultimately the bias is still higher. So in terms of, lots of people are reading, looking for reversals in the US dollar, which, from a positioning point of view, I can absolutely understand, but ultimately bias is still long the US dollars. When we review positioning, it's still only talking about futures markets. It's not talking about wider market, so I'll still be happy to be long US dollars. From a personal point of view, what you get long them against is a question between the ECB, between euro dollar cable, dollar Swiss and dollar CAD. FX reserves in Switzerland rising, which would make sense for a weaker Swiss franc. Maybe that is an option for dollar Swiss, but that's kind of how I'm thinking, which is not really kind of how you'd say things with the currency and the equity markets going the same way, but it's kind of what you'd have to back, and I suppose if you go long both, you'd probably be right on at least one of them. So, but yeah, likely to be a relatively quiet day today. We've got the Bank of England tomorrow, so we'll have a preview for the Bank of England tomorrow. See how it goes when we get there. But yeah, I'm going to wrap it up there. Best of luck trading today. Maybe keep your money in your pockets as much as you can. We'll see how the Bank of England pans out tomorrow.